headline driven, meaning that the market could enter into a pullback period where we see 3 to 4 to 5, maybe even 6 months, worst case scenario of bearish conditions because of market fundamentals. But eventually, due to the underlying support and fundamentals overall in the crypto ecosystem, we will likely see those prices rekindle, losses recouped, and the market continue with its overall uptrend once the sentiment improves. All right. So I'm not being fearful. I'm utilizing these discounted opportunities as exactly that, an opportunity to position myself for a continued rally once the market finds a floor. So for now, we are coming into August lows here on the higher time frame.
I just share something with you guys?
Of course you can.
So, I joined CyPRX about 3 years ago, and at the time,
Hey.
yeah, it's been a while. And at the time, I had two donut shops, and I just didn't really have the time to sit down and focus on the course, even though I knew I was like, this is gold. I have to focus and nail down. But last spring, I was able to sell one of my shops, and then I dove into DeFi for a good 2 months. Finished the course, and then I got so pumped because I was like, I understand this stuff now, and so then I went back into the CyberX course to do the whole forex thing. And then I just finished the 4.0 section like last week. And I just wanted to show you guys like these are my notes on they're like screenshots of all the charts and everything. And this is like the first notebook. This is my second notebook. This one starts the 2.0 section. And I just like have all this information now and I've been following the whole crypto thing and like investing in XRP, XPR, Kronos. Kronos, I only put in 4,000 to get the debit card, and now it's at $13,000. And I'm just like,
Yeah,
what?
yeah. Let's
I'm just
go.
like, and so it's so exciting. And honestly, I'm so glad that the timing worked out for me because it was last spring I sold my shop. I invested the majority of that into crypto, and then November Trump gets elected and everything just like spiked. It paid for my wedding. I have a baby shower this weekend. It's paying for that too. Like I don't have to work right now. Like I'm just like watching old Zoom calls to catch up and I'm excited to actually jump into like MetaTrader 4 now because now I can I can actually use it because I actually know how to hopefully read the charts well. But I just wanted to show you guys like these are notebooks that I've literally like
Yeah, great
I just
share. This is amazing. This is amazing.
You know what's
and
Yeah.
it's
wild
just
about that,
That's
May?
right here.
motivational.
Yeah, you
That's
know
kind
what's so crazy about what you just shared, May, is that you 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 just showed what it really takes to come into this community and actually make progress. There's a lot of people who come into a community like this and expect handouts, but in
of,
reality, that's not what this community is. This community is not here to give you a fish. It's here to teach you how to fish. And when you take the time and you study and you actually reciprocate the information and write it down and soak it up and then try to go out and apply it yourself, you start to slowly realize, like, oh shit, I'm not here to try to take signals from Cypress just because he's a millionaire and he's made money. He's teaching me how to make money and be a millionaire myself. And that's the power. And so all those notes that you have, the best part is, you and Mason are about to have a baby. Well, guess what? When your baby's old enough to understand and you're a multimillionaire, guess what? You can just pass that information down to them. And then it's a family bloodline transformation and it never ends. So
seriously.
alrighty, so this is just going to be a real quick Zoom call to wrap up the week. We're going to take a look back at what we were discussing and talking about at the beginning of the week on the onset on Sunday when we hosted our fundamental recap from the previous week and we did our overview and our outlook for what's set to come out this week. Take a look back at some of the things that we were saying on the 24th of August, as always, going over these markets week by week and just showing you guys not only the level of accuracy and how these videos are not necessarily to say that we told you so or anything like that, but just to show that these are the drivers that move these markets. These are the things that either bring on a risk sentiment, improving market conditions, creating bullish conditions, elevating asset prices and risk, or inversely, weighing on the sentiment, weighing on prices, and creating the environment in which we're currently operating in now, which is a risk off environment as we head into the weekend. Now, that's not to say that conditions or things couldn't change or that the market couldn't find support and turn around, considering that we're now headed into August lows where previous institutions had significantly bought from, driving prices higher. But we definitely need to see supportive fundamentals heading into the weekend and then into next week, which we will cover and end today's Zoom call with, taking a forward outlook into the headlines to be mindful of next week. But first, let's just take a look back, considering that right now the total cryptocurrency market is trading down about $136 billion. These are the days that we here in this community focus on dollar cost average positions to minimize that downside risk in our portfolio and maximize that upside return. So hopefully you guys weren't buying into any of the rallies or the pumps earlier on this week and using today or any other red days in the market to capitalize on discounted opportunities that you guys want to, adhere to in your personal portfolios. So going over to our August 24th report, that was Sunday at the beginning of the week. As of time of recording is the 29th, so 5 days later. Just taking a look at some highlights from our bearish worst case scenario that we had anticipated in this report. Taking a look at this, just looking at some of the highlights, we had mentioned that if inflation data stays elevated, if rate cut odds are lowered from 3, which is what the market was anticipating at the beginning of the week, down to 2 or pushed back into 2026, if the Bank of Japan hike odds increase, if geopolitical tariff tensions risk fuel to safe haven demand, that these would be some of the scenarios in which we would see risk assets sell off. And so now fast forward to more recent times. This was our call from August 26, 2025, where we had anticipated under those conditions that the market would most likely fail to break above previous highs and start to retrace down into August lows. Again, we don't have a crystal ball. We just use logical, not only technical analysis, but also fundamental analysis to gauge the current market conditions and what the market could do in the near future, week to week. In our August 25th report, we highlighted some of those ongoing uncertainties. We had shown you guys that there were some ongoing tariff-related uncertainties between China and the United States midweek. We also had increased tensions between Russia and Ukraine midweek as well. Progressing on to our August 28th report, we highlighted that we had some announcements from Bank of Japan speakers. And after that announcement, where I screenshotted this report from August 28th, the Economic Activity Prices and Monetary Policy Report in Japan from this member of the policy board here, specifically stated in her statement that, just in a nutshell, she signaled that rate hikes still remain on the table later on this year, right? And so obviously, of course, we know strengthening in the yen usually tends to correlate itself with a risk-off appetite. We also had gold rallying, more specifically today, to a 2-month high. All of these things that we had anticipated in the previous report, safe haven demand, Bank of Japan hikes increasing, or the odds of a Bank of Japan rate hike increasing, rate cuts due to elevated inflation being pushed back or lowered from 3 to 2, right? And so I'm just attempting to show you guys that now under these conditions, we're seeing the exact market environment in which we anticipated. No crystal ball, no Fibonacci extensions, no magic retail indicators, just simple logic analysis, realistic expectations, and no hopium. All right. So going over today's report in detail. On top of that, by the way, putting that aside, these are just some extra headlines, and I highlight these headlines for you guys to show you the vocabulary. You guys can see here in red and yellow, I have words like escalation and global trade tensions still lingering. Words right here like uncertainty in these reports. Here it says geopolitical tensions remain elevated as peace efforts falter. Down here it talks about the Fed independence and concerns have deepened. Escalation and global trade tensions. Then down here, this is demand. It says in this report, consequently, the greenback depreciated for the 3rd consecutive day as traders are seeking safety and had bought shares in currencies in the Swiss franc and the Japanese yen. So I'm just highlighting all these in this report today on August 29th to show you guys the environment is screaming intraday risk off. All right. So let's thoroughly read through this. Let's understand why, as we head into the weekend, the market sentiment is more risk off. And then what to pay attention to as we head into next week. All right. So people will constantly choose to ignore this information. It would behoove you guys to study it, to know it, to implement it in your investing and trading regime. So that way you know why the market's down. Because imagine if the sentiment continues to worsen in September and the market continues to pull back, how many people are going to think that we're entering into some bear market cycle when in reality, we've conveyed this multiple times in previous calls that the most likely conditions are headline driven, meaning that the market could enter into a pullback period where we see 3 to 4 to 5, maybe even 6 months, worst case scenario of bearish conditions because of market fundamentals. But eventually, due to the underlying support and fundamentals overall in the crypto ecosystem, we will likely see those prices rekindle, losses recouped, and the market continue with its overall uptrend once the sentiment improves. All right. So it's important for us to know these things so that way we're not fearful. We understand why our portfolios are bleeding red, why the market's down, and how we can position ourselves accordingly. So today, this is again just my personal opinion based off the research that I've done. You guys always take it upon yourselves to go and do further research on why the market sentiment has soured, but this is everything in today's report that I found. So the total cryptocurrency market cap has faced a sharp downturn, erasing over $120 billion in value as of time of recording. While such volatility is not unusual in digital assets, the drivers behind this latest decline are rooted in a broader shift in market sentiment. Rising inflationary pressures, lingering fears of a recession, and renewed demand for safe haven assets like gold have played a role in the dampening of risk appetite. I'll take your attention over here just to show you guys the inverse correlation in risk compared to safety. This is gold on the right hand side of my charts versus the total cryptocurrency market cap on the left hand side. If you look at when capital started rotating out of risk assets, i.e., crypto, it started to take place on Monday, August 11th, when the total cryptocurrency market cap rallied one last time to clear out any over-leveraged sellers, trap buyers at highs, and started to see profit taking. Inversely, same exact time frame over here on gold. On Monday, August 11th, gold started bottoming out. Same thing inversely, as above, so below. Buyers trap sellers at lows on gold, and we started to see a rally in gold and demand increase for safe haven assets at the same exact time that the total cryptocurrency market cap started seeing outflows. Sticky inflation keeps pressure on markets. The Federal Reserve's preferred inflationary gauge, the core PCE price index, rose today 0.3% month over month and accelerated to 2.9% annually, its highest reading in 5 months. This persistence in inflation underscores that price pressures remain embedded in the U.S. economy despite prior expectations of easing. At the same time, personal income and spending both advanced, reflecting robust demand even in the face of higher prices. While strong consumer activity can be viewed as a positive, in this context, it signals that inflation may not fade as quickly hoped. That complicates the Fed's policy outlook and weighs on risk sentiment, as investors question whether the central bank can cut rates aggressively without reigniting inflationary pressures. Now, as of time of recording, the rate cut odds still remain on the table above 80% probability in September. However, the odds of a rate cut in October and December are starting to slightly decline. Here we can even see a report directly from Morgan Stanley that they just put out their anticipation of rate cuts and the trajectory, where they said here in this report, Fed Chair Jerome Powell signaled in his annual speech in Jackson Hole, Wyoming, that a rate cut cycle could start in September. Morgan Stanley's Global Investment Committee acknowledges the political pressure on the Fed to ease monetary policy, which if you guys go and read the CYPRX analysis chat this rising, I said this exact same thing, that I think that Chair Jerome Powell hinted at a rate cut last week on Friday because of the political pressure that he's experiencing. We also recognize that there has been some labor market cooling that might support a proactive rate cut. Overall, however, we see the case for a reduction as modest and put the odds much lower than what the market is anticipating, around a 50-50% probability. This is coming directly from Lisa Chalette, the Chief Investment Officer and head of the Global Investment Office at Morgan Stanley Wealth Management. Then this report goes on to say down here, employment and inflation reports in September should give investors greater clarity on the economic outlook and the potential for cuts. Then down here it says, look to add real assets like gold, real estate investment trusts, energy infrastructure, Industrial and agriculture commodities to complement portfolios that are benchmark weighted in passive U.S. equities. Also consider active stock selection and consumer oriented in U.S. large cap quality names. So they're literally telling their investors pretty much right now temporarily to rotate into safe haven assets, particularly like gold they highlight here, right? Although consumer spending remains resilient, warning signs are flashing elsewhere. The University of Michigan's Consumer Sentiment Index today slipped to 58.2 in August from a recent 5-month high, signaling growing unease among households. Expectations for business conditions and labor market stability also weakened, while year ahead inflation expectations climbed to 4.8%. This combination of sluggish confidence, stubborn inflation, and rising uncertainty, which I highlighted in bold, feeds into recession concerns. Investors are increasingly wary that policy missteps or external shocks could tip the U.S. economy into a downturn. We've experienced this in previous cycles, where if we go back and we look at historical data, one of the primary reasons, if we go all the way back in time in the total cryptocurrency market cap, let's delete these drawings real quick. Go to the higher time frame, and we go back to last year around the same time horizon when the market was anticipating rate cuts in September and all these things. Well, prior to that, this was the first week of August. This massive liquidation event that took place in crypto, or huge decline of almost $1 trillion in value from top to bottom. I believe it was 700 billion, if I'm not mistaken. Yeah, $758 billion wiped from the market before the market started to recover, was primarily driven by two things. We had the Bank of Japan hike rates unexpectedly above what the market was expecting, from 25 basis points to a 50 basis point rate hike. On top of that, the week after, we had non-farm payroll come out and miss the market expectations, showing significant economic weakness in the United States economy, which led to the market significantly fearful of a recession. Gold demand spiked, risk assets sold off. Then eventually, when the Fed cut rates in September, the market recovered, right? And so these temporary pullbacks, if you're knowledgeable about them and you understand why they happen, can be seen as an opportunity to enter into discounted prices, knowing that the underlying fundamentals in crypto have not changed. And we're starting to see those cracks now. Investors, like I said, are increasingly wary that policy missteps or external shocks could tip the U.S. economy into a downturn. Amid these uncertainties, gold has reemerged as a preferred refuge for capital. Prices today climbed to $3,425 per ounce, approaching the April record high of $3,500. I wouldn't be surprised if by year end that high is beat or surpassed. The yellow metal has gained around 4% in August, its strongest monthly performance since April, as global investors sought shelter from sticky inflation and political uncertainty surrounding the Federal Reserve's next moves. Gold's appeal lies in its historic role as a store of value when confidence in fiat systems and policymaker credibility wavers. With political pressures mounting on the Fed and the U.S. economy, navigating both inflation and recession concerns, gold's allure is amplified, which we're currently seeing today. For cryptocurrencies, this shift towards safety comes at a cost. The capital fleeing into gold and other safe haven assets reflects a decline in risk appetite, which naturally impacts high volatile markets like crypto. Despite strong narratives around the blockchain adoption and utility, investor psychology still remains closely tied to macroeconomic conditions while we're currently operating in this trading environment. When inflation appears sticky, consumer confidence weakens, and gold prices surge, risk assets tend to suffer, which we anticipated and highlighted at the beginning of the week in our breakdown on the 24th. That is precisely what has played out this week, with the crypto market facing heavy outflows and diminished appetite for speculative positioning. On top of all that, like I mentioned, we had escalating tensions in global trade. We had geopolitical tensions remaining elevated. We had the Fed independence concerns deepen on Thursday as President Trump's attempt to dismiss Fed Governor Lisa Cook escalated into a legal showdown. That usually, again, tends to create market uncertainty. We also had escalation between the ECB being concerned about uncertainty, adding that there was considerable discussions on the role of uncertainty. This is a report that has the word uncertainty in it twice, which remained very high, related both to trade policy and geopolitics. Last but not least, this piece of the article, like I mentioned, Signals at safe haven demand and other assets outside of the dollar and both Swiss franc and the Japanese yen, which are signals of a risk off appetite. So the souring of risk sentiment highlights a reality that many investors tend to overlook. Crypto does not exist in isolation. It is a part of the larger financial system where capital flows shift rapidly depending on inflation data, consumer behavior, and central bank credibility. Right now, those outflows are favoring gold over digital assets. Until inflation shows clearer signs of moderation and recession concerns ease, safe haven demand will most likely remain strong, and risk assets like crypto may continue to feel the weight of cautious investors. So, why, if higher rate cut odds are still on the table, did the market drop? At a first glance, an increase in the probability of a September cut should be supportive for risk assets like crypto. After all, easy monetary policy means cheaper liquidity and a friendlier environment for speculation. However, the drop today of $130 billion in crypto shows that sentiment is not being driven purely by rate cut expectations. So, number one, rate cuts are coming for the wrong reasons. Markets like to see rate cuts because of stability, not because of cracks in the system. The odds for a September cut ticked higher after the latest inflation data, but the context matters. Core PCE inflation rose to 2.9%, which is still way above the Fed's 2% target. Consumer confidence weakened sharply, and recession fears are rising as households reported worse buying conditions and more anxiety about jobs. And you can see that in this headline. Anytime that you see that key vocabulary word, recessionary fears rising, is usually tend to be reflected in sell-off or sell pressure on riskier assets. This combination tells investors that rate cuts aren't being discussed because the economy is strong. They are on the table because risks of slowdowns and instability are growing. That flips the narrative from bullish to cautious. Number two, sticky inflation is limiting policy space moving forward. Yes, the Fed may still cut in September, but sticky inflation means that the Fed's room to maneuver moving forward is limited. If inflation remains stubborn, the central bank cannot deliver deep cuts the remainder of this year without risking credibility. That's why the markets now see only one or two cuts through year end instead of three cuts that were previously priced in earlier on in the year. If you guys remember in previous Zoom calls, this was my personal thesis as to why I thought the market would pull back, is that the market was getting way too ahead of itself. I firmly believe that rate cuts are still on the table in September, but that the market's not going to deliver rate cuts in October and December unless the data warrants it. And Jerome Powell's most likely going to come out in September and deliver a hawkish cut, meaning he's going to cut in September, but then say, look, we're probably not going to cut again unless the data supports it or inflation substantially comes down from where we're currently seeing it at today. Here you can see Fed Governor Christopher Waller even supporting that same exact thesis, where he said that a 25 basis point cut still remains on the table, but Waller downplayed the case for a larger 50 basis point move next month and added that the view, of course, could change if employment reports in August points to a substantial weakening in the economy and inflation remains well contained. Last but not least, we had safe haven flows divert capital. Gold spiking to $3,425 per ounce near record highs signals that investors are seeking shelter. Safe haven demand directly competes with risk assets like crypto. When gold rallies this aggressively, it usually means that capital is being pulled out of risk markets and redirected into defensive plays, which I already showed you guys in real time. Right? So outside of that, that is all that I have for you guys for today in terms of why the market sentiment is soured. We have geopolitical tensions still on the table, trade uncertainties escalating, demand for safe haven assets, not only in gold, but also in other fiat currencies as the dollar is weakening, in yen and Swiss franc. And we also have sticky and troublesome inflation on the table, slightly deteriorating rate cut odds later on this year in October and December. All of those are a perfect catalyst and storm to weigh on risk sentiment till the sentiment till the sentiment improves. This sell pressure is likely to continue. Now, with that being said, I mentioned this to you guys before. I'm still bullish overall on the total cryptocurrency market cap, that eventually we will find some type of floor. Let's go back to the higher time frame. That eventually, just like in previous market cycles, in 2023 rolling into 2024, when the market corrected 39%, found a floor, continued its rally. Same thing in 2024, rolling into 2025, we saw the same exact correction take place. And both of these corrections were primarily driven by market fundamentals: higher inflation, a more hawkish leaning Fed, geopolitical tensions and tariff escalations unfolding, creating a souring in market sentiment. And we're starting to see that unfold now. The primary reason for this pullback started in the middle of August when we had higher inflation reports and both the CPI and PPI figures dampen rate cut odds. Even though those odds remain on the table due to a weakening in the unemployment and labor market figures, sticky and troublesome inflation is still creating market uncertainty in the trajectory of the bank or the Fed policy positioning. All right. So as long as this current uncertainty continues to linger, this most recent pullback that we are currently living through is likely to continue. I still have a firm belief, like I said, that what's most likely taking place is the same thing that took place at the end of previous years, 2023 into 2024, and then 2024 into 2025, is these market makers are just repositioning as we are heading into the last quarter of the year. All right. So I'm not being fearful. I'm utilizing these discounted opportunities as exactly that, an opportunity to position myself for a continued rally once the market finds a floor.